Hey, I'm Vishnu Srinivas, and you're listening to the Hawkeye podcast. Joining me today is Claudia Sahm. She is the leader of Stay at Home Macro Consulting and a former Fed Reserve and White House economist. Thanks so much for taking the time to speak with me today.
Yeah, happy to be here.
Awesome. So, do you want to give a short introduction on your background and your role?
Yeah, so I guess first I'll say I have my PhD in economics from the University of Michigan, so I'm very excited to be on this show. Go Blue! When I finished my PhD in 2007, I started at the Federal Reserve, the Board of Governors in DC, and I was a lead on consumer spending. And very quickly, we fell into the Great Recession and the financial crisis. And that was my first few years were an absolute birth by fire as a real world economist. But I've learned a lot. And then that has very much prepared me for being an economic advisor in this moment. So as towards the end of the Obama administration, I had an opportunity to serve at the Council of Economic Advisors as a senior economist. So I've seen monetary policy and fiscal policy, and I also worked in the community development division at the board before I left. So I've also seen the regulatory and kind of out with the people work that the Federal Reserve does. And I left at the end of 2019 to help advise Congress on how to prepare for the next recession. And then it came very quickly. So the past 2 years, like for a lot of people, have been an absolute whirlwind with lots of ups and downs. But I have had the opportunity to do a lot of advising to Congress, and I do a lot of public writing. I have a Substack. I also write regularly for Bloomberg Opinion, lots of other places. I have a lot to say, probably more than I should say. But it's been a real opportunity, but it's a challenging time. So
Awesome. Yeah, that's definitely true. And like where I'd like to start is kind of in recent news. There was obviously last summer, multiple states cut their unemployment benefits a few months early, I guess with the rationale that
mhm.
this would improve hiring rates. And, in the last couple of days, I think, there were findings that this did not come to fruition. So I guess, does this outcome surprise you, or do you feel like this policy was never really the answer?
So no, cutting off unemployment benefits having little effect on hiring, that doesn't surprise me. Now I will say the studies that are coming out, they're well done. The dust has not settled. Like it is very hard at any point in time to have a clear um, estimate or a clear understanding of what a policy, particularly macroeconomic policy that happens across the country all at one point in time, or I mean, here this was a large number of states, to really understand what was the effect of that policy. So I have to be a little careful because my impression, and I wrote about this at Bloomberg Opinion in June of last year, right while the states were starting to go down this path, the Republican states. And I said, I don't think this is going to move the needle. And I gave a whole lot of other ideas about how to get people back to work, above all, get the pandemic under control. But I had other ideas. And so I have to be a little careful because the result of these research doesn't surprise me, but confirmation bias. Now, what I do know is that cutting off the jobless benefits and cutting them off earlier than people had expected. When the American Rescue Plan passed in March, the benefits, the extra benefits for the unemployed were set to expire in September. So this meant in all of these Republican states, some of which had unemployment rates like Texas, unemployment rates above the national average. So people, the unemployed, their families, just by the bad luck of where they lived, lost their benefits early. There's no economic model. There's no state of the world where I mean, just in life in general, here I'm going to help you. Oh, no, I'm not. Right? Like that's extremely disruptive. So even I'm sure there were people that to feed their kids had to go back to work, right? Like there are incentives to work. And yet it didn't, we still have a lot of labor shortages. It's still difficult. There are high wages. That's good for workers. It ends up getting passed on to consumers. Like we can debate that. But the one thing I do know is for the families that lost those benefits, there was real hardship. right? And so that one, I don't need a study to know that if you go from having money one week to having no money the next week, that's bad. But it's an important discussion, and we will be doing research and debating the merits of the rescue plan until the day I die, and then afterwards others will carry the torch, which we should. But I think, in this moment, policymakers, I mean, those governors were trying to solve a problem too. I disagreed with the solution, but they were trying to solve a problem. We still got a lot of problems. So we're not done here. Policymakers can't throw in the towel, but it's tough, right? There is no one solution that's going to fix it all.
Yeah, and it really can't be understated, like the psychological impact that this would have on people who are expecting these unemployment benefits. You've obviously done a lot of work on and analysis on like recessions. So I'm curious to get your thoughts because there's a lot of speculation and drama in the news that we might be on the brink of another recession. I guess, especially in light of another potential interest rate rise on the horizon. So, do you think these rumors are overblown?
Yeah, so I guess I'll back, and probably the thing in the fiscal policy world that I'm best known for is having developed a recession indicator. So it's called the Sahm rule. I did not name it that. It was a recession indicator in my chapter, but whatever. I guess it's nice to have a rule. But what it says is that when the unemployment rate, and I take the 3-month moving average because you want to like take out the bumps and wiggles, but when the 3-month moving average, the latest number is a 0.5 percentage point or more above that lowest number over the past 12 months, we are in a recession. It's not a forecast of a recession. We are in probably the first few, like 3-4 months of a recession. That has been a statistical regularity for every recession since the 1970s. There are no false positives. The dynamic is, and I mean, I didn't make this up. Other people knew this. I made a formal rule, but once the labor market starts going and the unemployment rate starts rising, a 0.5 percentage point is not much, right? Once it starts going, it has a tendency to keep going, right? And so, and a recession, like we've never had a recession without the unemployment rate rising because that's kind of like what a recession is, right? So this statistical regularities, referred as the Sahm rule, the only reason I developed it is so that you could put fiscal policy on autopilot. So I've done a lot of work on stimulus checks. The idea is once the Sahm rule triggers, you send out the checks. I worked on legislation with Senator Bennett's office and others on using the Sahm rule to trigger these extra unemployment benefits, right? So this idea of like figure it out ahead of time, get the details, pass it through Congress, and then just let her go, right? So that's why the Sahm rule exists. Now, recently, much to my dismay, but not surprise, it has been weaponized by some people who are very concerned about a recession. To just cut to the chase, looking at what's going on in the world, and it's really tough. Like I am a professional forecaster. I have done this. I have learned from the best of the best, but I've also learned from the best of the best that it's always hard to forecast. And I also know looking at it's like basically impossible. But policymakers need help. We do our best. We look at the data. So I understand why the recession fears are out there, but I put like right now, given what we know, and the world keeps changing, so policy advice changes as it goes. I put the odds of a recession next year at about 30 to 40%, right? And I put a very low odds on a severe recession. So when I look out at the world, so my most likely, what I think is most likely, the staff calls this like the modal forecast, the staff forecast. To me, the most likely forecast is that we have the economy cool off. We're running really well right now. Consumers are spending, jobs are out there. I think that there's room to cool off the US economy. I don't think much of Europe has this space, but I think in the United States, we have this extra cushion. Things will cool off and we will not fall into a recession in the sense that unemployment like really goes up, spending goes down. Now, and Goldman Sachs, like there are some really, really good forecast shops out there. that are with me, right? Like, so, but we could all be wrong. Most of us were totally wrong about inflation dynamics. Last year, we were totally wrong about COVID, right? Like, it wasn't transitory either. But I do think, and I wrote a Substack post about this because I watch people talking about the Sahm rule, because the unemployment rate is really low. And frankly, it's probably lower than the official number, which is at 3.6%, just because you have these people out of the labor force. And if they came back and there's a lot of demand for them, the unemployment rate go lower. So we have a very low unemployment rate. And as you said, the Fed is trying to cool things off by raising interest rates. I think they have space to do it by largely consumers slowing down the growth. Like, instead of 5% growth, we have 3% growth. I think business investment, the same thing. But it's entirely possible that in that cooling, you will see the unemployment rate rise. And there could be a lot of reasons about how people come in or don't, or right. Like, there's a lot going on under the hood. There always is. I think, and what I discussed in the Substack post, rules are made to be broken, right? The Sahm rule is a statistical regularity. It is not actually like a rule. Like, macro has none of those. Like, we are not physics, right? Like, we have, people are not particles. Like, they do the darndest things. So I think it is possible that we could see the unemployment rate rise some. I actually think it's going to go slow enough, if it does, that it's not, it wouldn't trigger the Sahm rule. But I get the argument, but at the end of the day, it's really about, does demand collapse? Does unemployment really shoot up? I mean, if it really were just a 0.5 percentage point increase, that ain't a recession. Like, there's no way they're going to call a recession at 4% inflation, or I'm sorry, 4% unemployment, 3% inflation, and consumer spending growth, inflation adjusted at like 3%. Like, that is not a recession, even if the Sahm rule said it's a recession, right? Like, consumer sentiment looks really bad. There are some indicators that would say we're in a recession. Look around. No, we are not in a recession right now. So, but the things can change rapidly. And like I said, I understand why we're having this discussion. I disagree with the doomsayers, and I try hard to not get angry at them, but like, they get to have an opinion. I do too. We're doing the best we can, but the thing that the Fed, they have to get inflation down. They've been very clear about that. They're going to act, no matter how limited their tools are for the kind of inflation that we have right now. They're going to act, but they have, when they say we are working to get inflation down, they always follow it with, and our intention is not to cause a recession. Like, they have their eye on the ball. That doesn't mean they can deliver, but they are fully aware that we made a lot of progress in the labor market. We are not to the finish line, but the idea is to like get us all across the finish line. Stable prices and maximum employment. Fingers crossed. So sorry.
No, totally. And I think it kind of gets lost in the shuffle because, the Fed seems like kind of employed like a kind of strategic approach to addressing all these issues that came at once, right? Because, they had historically, high unemployment and like in the wake of the during the COVID pandemic, and they were somehow able to bring that to really low rates and also boost consumer spending a lot in the wake of this pandemic that is still going on actually. So I guess, like, do you feel like this is a net positive, or shouldn't this be regarded as a net positive, or do you think the Fed is just like an easy scapegoat for people?
Yeah, so I think in this moment, nobody should be doing a victory dance. No one should be, I mean, it's fine that we're starting to see research that looks back at the rescue plan or decisions of Republican governors. I mean, that research we need to have that research. This is my Fed training too. Like, you put the fires out while the world is ablaze. And there is time for introspection. There is time to think about how would we do it better next time. But the world does not wait for you to get all the data you need, to get all the research you need. Jay Powell, Fed chair, has been very clear in recent months that if the Fed knew then what it knows now, and I think this is particularly with the persistence of COVID and the supply chains, a war in Europe, right? Like if it had known all of that, say this time last year, particularly in the fall, they would have started raising rates sooner. Like he's very clear about that. And you can find all kinds of commentators that will affirm that Jay Powell, that the Fed was quote unquote behind the curve, meaning that they waited too long to raise rates. But you know what? Like it's completely beside the point right now, right? Because we have high inflation, we have a crisis that's ongoing, and what the Fed does is it does to the best of its ability. It backs up. I mean, on the staff forecast, when the data came in and they did not confirm our forecast, or even they put it really in question, we changed the forecast, right? Like you don't hold on just so you can say you were right. I don't think it's appropriate to be doing the victory dance. Frankly, I was trained that you never do. Like as a forecaster, and I was taught this by an officer right after I'd had this really big hit on, like I projected, I mean, it was really like, wow, I did that. Using actually Michigan's survey, the surveys of consumers, like I was doing some estimate on income. And he came in my office early because, checking in because he did, called New York Fed for the morning call and stuff. And he looked at me and he's like, you don't brag. Because he's like, when you have a hit like that, you're either lucky. Sometimes we actually do have good luck. I mean, the last 2 years just feels like rolling bad luck, but you could be lucky. And if you weren't lucky and you really like nailed it, he's like, everybody knows you don't need to brag, right? So there is a part of me, this is a very Fed specific training. Like I didn't get this at Michigan in the macro department. I don't get it when I'm out like on the news shows talking to people. So it really jars me a little bit that there's some victory laps being done when inflation's only been high for a year. Like the 1970s, it was high for a decade. Like we got to get it down, but it's like, I don't know why. Like to me, it's very misplaced. But I take a lot of comfort that the Fed, they keep going. It's fine if other people are doing a victory lap. I mean, it's like people are going to do what they're going to do. What's important is the Fed keeps assessing the data, keeps listening and thinking about what's the right story, what's coming together. And a big part of what we do is look for the risks. Like all of my forecasts, like the recession forecasts, are conditioned on COVID starts to recede. Demand, like the Fed is able to cool off demand. The war in Ukraine does not become a war more broadly, right? And so those, like when we start the forecast, when I like mentally start my forecast, you have a set of assumptions. And these aren't economic, this is like things in the world, right? And you start with those assumptions and then you think, okay, if that's the underlying like things happening in the world, like the pandemic, the supply chain, then on top of that, you build, what would that do to the economy? Like, and you think about the feedback loops. So sometimes I get frustrated with other people that have different trainings where they spin this like, we're going to have a recession next year. It's the 1970s all over again. So I'm like, okay, where what are we assuming here? We don't have unions like we did in the 70s. We have COVID, we have a war. So to me, like we have to, the story has to hang together. My story doesn't have to be right, but I really want to be able to articulate it when someone like you ask me where it comes from. So I think we're, you just, for me, like I have a lot of confidence in the Fed because they're much more skilled than they were in the past, the 1970s, but even the early 2000s. The Fed learns, the world changes. As Janet Yellen, current Secretary of the Treasury and former Fed chair, said recently, the Fed will need skill and it will need luck to do what's called the soft landing. So bring inflation down without pushing us into a recession. The Fed has skills. They are much more skilled. They've done a really good job during this crisis, given all that they were served up to deal with. but they do need some luck. Like we need something in the world to break our way, like in a good way, not like smash into a million pieces like what the last 2 years have been. But if those two things come together, the Fed will make the nearly impossible possible. So with a lot of help. Like it's not, the Fed is not doing this alone. Congress and the White House have a role to play, particularly with gas prices, food. And at the end of the day, it's kind of consumers. Like if they keep buying things we don't have enough of, the prices aren't coming down. But people are going to do what they can do, and policymakers do have real constraints over what they can actually get done.
Definitely. And yeah, like our policies and responses in the 70s don't seem nearly as informed or pragmatic as they are, at least today.
Yep. Yep.
What's really interesting is the idea that what like having luck roll our way, because while the Fed might be like making a concerted effort to like drive prices down, tensions are obviously, like you said, growing worse in Russia and Ukraine. And ultimately, do you think it'll be out of the Fed's control to bring down, like, let's say, like the price of gas if this conflict wages on?
Well, with gasoline in particular, and this is true for food as well, the amount that people want to buy is very stable. The only way that the Federal Reserve could bring gas prices down is to throw us into a very severe recession. The COVID crisis, when we shut it all down, is one of the few times that you see a dramatic drop in the quantity, the amount of gasoline purchased. Now, gas prices, because the supply fluctuates because of OPEC or because of like a hurricane that hits the refineries off the coast of Texas. I mean, there are things that happen often, because you look at gas, and if you look at energy and food prices over time, they move around. It was very unfortunate this time that we kind of have this super cycle of like goods prices were going, like cars and things like that. And also we had gas. Like these didn't have to come together. The war in Ukraine, because Ukraine is a breadbasket and Russia is a major producer of oil, like that constrained supply when supply was already constrained. Like OPEC has not been willing to get production back up to pre-COVID levels, even though demand is actually there. So all that said, like we drive to work there and back. If it's cheaper, we don't go to work twice, right? Like you go and you come back. If it's expensive, you still got to get there to the best of your ability, because if you don't go, you don't have a job the next day, right? So for a lot of people, so demand is like this. And remember, the Fed, by moving interest rates around, interest rates are a price. Like when you buy a house, you got to put a down payment, but how high the interest rate is affects your monthly payment. And they do check, like, do you actually have enough income to do this? And so the mortgage rate, just like the house price, both are prices, and they can either boost demand when interest rates are really low, or they can dampen demand and cool it off some. So that's a sector. Any place you have to borrow, homes, cars, some big durable purchases, the Fed has the ability to cool it off. And then that demand could, other sector, it could like spread some, but that's the primary place the Fed has a kind of touch point. Most Americans do not put their gasoline on their credit card, right? And again, you need to go to work, like however much gas you're buying is not dependent on the price, right? So the Fed can't affect that. There are policies. There is no one solution. The most immediate thing is we need more supply. The Biden administration, even though it runs counter to a very important goal of getting us to green energy, getting us off the gasoline, like in this moment, we can't get the electric cars out. We can't get all the windmills up that we need. And so the Biden administration took steps to release many more barrels of gasoline or barrels of oil out of the strategic reserves. They've actually gone in and done that twice, and that had an effect on the price of gasoline, helped bring it down. The war in Ukraine offsets that, right? Like, gas had been really high, like 440 on average, and now it's kind of back down to 410-ish, and it fluctuates. So it made a difference, but it did not get us back to the 3.50 a gallon or $3 a gallon before COVID. I spoke to a large group of House Democrats recently, and one of my main points to them was to move heaven and earth to get gas prices down. Like, this is really weighing on people, both their pocketbooks and their psychology of, how they look at the world right now. And you cannot expect the Fed to do that one, right? Like, that's just, and I think there are a lot of policy measures. None of them are perfect. And frankly, you're talking about doing big policies that maybe get you 10 cents off a gallon. But as I have told people, when I call home to Indiana and my mom tells me what the price at the Walmart gas station is, like, she tells me when it moves 10 cents, 20 cents. Like, this makes a difference to a lot of people. Not a lot of people like me who are in Washington advising members of Congress, but they get it. I mean, they're voters at home. So I think that's where the White House, Congress, they can do something, but really at the end of the day, we got to restore democracy in the Ukraine, get Russia under control, get OPEC to produce. Like, it's the supply in the end, because the demand, the Fed can't affect it, and frankly, basically nobody can affect it. Right? We want people to go to work. In most of the country, they gotta fill the tank. So
Definitely, yeah. I think it's really important, like, not just like speak strictly in terms of like theoretical terms, but like also realize, inflation does weigh on people's psychology and obviously their pocketbooks. Last question for you, Dr. Sahm. Another thing that like kind of might be out of control is of like the Fed is like the supply chains are still in disarray. Production facilities in China are still getting locked down from like COVID outbreaks that are happening, and obviously semiconductor shortages still remain a problem, and that obviously leads to lower like auto production when like, they depend on so much. So I guess you touched on this a bit earlier, but do you foresee this imbalance in supply and demand remaining an issue that we have to tackle with in the future?
So what I see based on the scraps of data that are coming in, and I look at all of it, I I see some signs of a very slow but positive adjustment on the supply side, right? Like, it's going to take a while, right? But there are signs, like lumber prices have come down some, and shipping costs, which is very directly related to the supply chains, they are coming down some. The port in LA, goods are moving off, the ships that had been like this floating, many ships out there. So there are these signs of progress. The reason that I feel strongly that it's not just like, oh, they've started and like those prices are going to come down and down is, and the goods coming, right? Like, when there's less stress on the supply chains, that's where the price starts to normalize and come down, or at least stop not rising so quickly. We'll take anything at this point. Because inflation is about an increase in prices, right? So like, we got to step that down. The price level is actually going to be higher, probably notably higher than it was pre-COVID, but well, like I said, one step at a time. But what's happening in China, which frankly is not getting enough attention, in my opinion. I mean, there's so much in the world to just like grab us and keep us up at night. But Shanghai, the Chinese government basically shut down the city of Shanghai that has tens of millions of people. There are more people throughout China, like millions and millions more people in China who are locked down. Shanghai has one of the largest ports in China. Those ports are not functioning because people are, locked up in their homes. The United States has absolutely no control over how China or any other government addresses or tries to address COVID. China's had a zero tolerance policy. They have not had a vaccine that is effective. And they're actually a country that can enforce a zero tolerance and like lock up people in their homes. So that we may be getting a respite, in the sense that like the Shanghai port's not working may mean that LA is able to work through the backlog, right? Because you don't have this all, so we're catching up. Well, then that will be bad. Like, that's good right now, and you could have the prices coming down, but that we could quote unquote pay for that on the other side. The thing that I'm actually more hopeful about demand cooling, because right now we've had really strong demand, and a lot of that's because we put out the stimulus checks, we gave the extra unemployment back. I mean, like, people who have never had money have money in the bank. I mean, this is like, wow, this can actually happen. Low wage workers got raises. Who knew that was possible, right? Like, so I mean, the most important determinant of people going out and spending is income.
Mhm.
People have had money, and they've had, I mean, Americans like to spend in general. We are a consumption led economy, but also there were a lot of people that didn't have the money to spend before on things they needed. Like, clearly, there were a lot of people that needed a used car, or they wouldn't be paying the price that they're paying right now, and they had the money to do it. So the thing is those stimulus checks are gone. Everyone has lost the unemployment benefits. The wage increases we saw at the low end over the summer, those have started to taper off. And then the prices are high. I mean, you look in the surveys, you ask people, is it a good time to buy a large household item? And they're like, no, it is not a good time. And they don't, like, they're not saying, oh, it's a good time because prices are going to go even higher.
Yeah.
There was that behavior in the 70s, and that creates the spiral. People are starting to be like, are you kidding me? I'm not paying that. And they also think that the price is coming down. So, like, that, anything we can do to just take the pressure off a little bit on the demand, that will give time for supply. I mean, that on its own will help cool off prices. And then if it gives time for supply to catch up at like this more cooled off level, then you could really see things move. The sign that the one, I don't know, there's lots of little glimmers of hope out there. But one thing that really struck me in the last consumer price index release that was recent and for the month of March, yeah, that we got for March, is that it showed that used car prices fell pretty notably. And that was important because those supply chain issues related to cars, they have not been resolved. There's still a lot of demand in the new car market. There aren't the new cars, which it's the new cars that need the semiconductors, right? Because they're like, now we build these things, little whiz bangs. But it's those people who wanted new cars and couldn't get new cars, they went into the used car market, they have a lot of money and they bid up the price. So we haven't fixed the supply chain. The production is still below demand, given like the supply is not there. But for the prices to go down, that means that some consumers, they're staying home, right? And if you don't have as much demand, it is better for an auto dealer to lower the price by 4% than to get no sale at all, right? So that's where, to me, that was encouraging, because that's actually seeing it come through a demand channel as opposed to the supply channel. Because I, like Jay Powell, we ain't betting on that supply channel fixing anytime soon. COVID is still here. The war in Ukraine is not going to be won quickly. And they're not problem that the Fed can address. So if we start seeing it on the demand side, that can give us the breathing room now, and supply will, we're going to get this worked out. But we need to get inflation down, because it is a hardship right now, and we cannot wait for COVID to decide it's done with us, or Putin to find his soul, like, so like, but I think there are signs in the data, but we have to be vigilant and keep looking. And the Fed is absolutely not at the point where like, oh yeah, we got this, right? Like, it's okay. They've actually been signaling very clearly and very, I don't want to use the word aggressive, but they're very clear. Next week, we're raising it 50 basis points. And they've almost, in my opinion, signaled another 50 basis points in June. It's very rare for the Fed to go into a meeting ahead of time with some really strong guidance. And 2 meetings out is basically unheard of. And then they use the words like, and we'll raise interest rates expeditiously, which means, but they're gonna pay attention to what the effects are on the economy. Again, they are fully committed to containing inflation without causing a recession. If they raise them 75 basis points, next 2 meetings, then 50, that, like, the US economy has a cushion, but only to a point, right? That would be a very fast way to get inflation down, but that's like a break the glass kind of move. And there's absolutely no case for a break the glass. There might have been with Volcker in 81, but there's not right now. So, but they're walking a tightrope, but we all are. Like this is not a good time for anybody, but there is a path forward, and the Fed will keep moving on that path to the best of its ability.
Definitely. I think bringing down inflation has to be the main priority right now. Thank you so much, Dr. Claudia Sahm, for joining me today on this podcast. Really appreciate the time.
Yeah, great. Thank you so much. I really enjoyed it.